Good evening, everyone. Good evening, and welcome to this episode of Market Wrap. I have with me Mr. Pankaj Pandey, and interesting week again. We saw somewhat flattish, and Friday gave some moves, but on the wrong side, maybe for portfolio holders. Sir, as of now, what do you see happening in the market after a long run up? Finally, it looks to be taking a pause.
Hi, good evening, Vishu. Yes, so this week overall, we've seen Nifty gaining about 1.2 odd percent. The broader markets, mid caps have done even better. And like you said, Friday we got some jitters of this India-Pakistan tension. And good part is that while banking has been sort of doing well for a decent period of time, we have seen IT sort of staging a strong comeback, up about 7 odd percent. Now, our sense is that next week it's a truncated week. So what we would expect is that Nifty to sort of on the higher side, 24,500 would be the resistance, and supports are placed at somewhere about 23,300 to 23,000 kind of a levels. Now, since we are talking of war-related jitters, we have seen three conflicts between India and Pakistan in the past 3 decades. We had Kargil War, we had 26 by 11 Pulwama. And on all these occasions, we have seen markets bottoming once the anxiety sort of settled down. And once that happens, we have seen a double digit kind of a return in the next 3 months. So I think if someone has not really participated in the recent up move, because we have seen 12% kind of a rally, and obviously there is a feeling in some investors that they've lost out. So I think this is another opportunity to sort of get into the market at attractive prices, because our sense is that, like I said, last three conflicts we have seen markets sort of doing very well post the event sort of settling down. So overall, advice would be to sort of not to panic and in fact look for quality stocks. So this is again a moment of an opportunity for someone who has missed the earlier rally.
Absolutely. Another talked about thing in the market right now is gold. We recently hit 1 lakh finally after years and years. And now again, this has been volatile, and we saw some fall there as well in the recent week. What do you think about gold? Is it a right time to get into gold, maybe?
So when you look at the gold returns, 1 year 32%, 3 year 20%, 20-year return, it's about 12.5%, and now it is compared to Nifty kind of a returns.
Yeah.
Now, see, last 4 months, actually, gold has rallied about 35 odd percent. Now, if whenever you see such a sort of a sharp move, overall sense is that it is technically in a overbought territory, and which is why a temporary breather cannot be ruled out. And overall, our sense is that see, gold has been sort of benefiting from major factors. So it is capturing all the chaos which has been in the market in the recent past. So we had trade war concerns. Then the overall inflationary concerns in the US are at its peak since 1991. Similarly, global growth is coming down. Growth in the US was expected 2%. Now it is expected to be about 1.4%. You have a lot of geopolitical tension, be it Russia, Ukraine, Israel, Palestine, then US, Iran. Then there is an interest rate cut being already happening. The other talk of the town is that the central banks have been buying gold. So in fact, and which is true also since 2002. Every year they used to buy about 500 tons. What they are doing now, or they are buying, is about 1,050 odd tons. So while all this is positive for gold, but all these are at extreme levels. And which is why we feel that any kind of a cool off in anywhere. So, for example, when we look at the RBI buying, so RBI has been sort of buying gold, has done record buying, but of late, their gold buying has been reduced by half on a monthly basis. And to give you perspective, gold does well, yes. So there have been periods. So, for example, 2002 to 2012. Now, in this 10-year period, the gold moved from, say, 5,000 rupees per 10 gram to about 30,000 rupees. And then subsequent 6 years, absolutely no returns. In fact, global gold prices corrected by 45 odd percent. But since the rupee depreciated, so which is why the Indian gold prices really did not came off so much. And which is why even if you look at in the last say few years, 2019 to 2025, from 30,000 per ton gram levels, it has moved to nearly 90,000 and now 1 lakh. So 3x kind of a move. Now, whenever you are seeing this kind of a move, our sense is that this is not a time to sort of turn bullish, despite the fact that yes, there are issues with currencies globally. There are issues with the debt to GDP ratios being very high for a lot of central banks, and a lot of challenges for dollar, and also the historical perspective of Indian currency depreciation vis-a-vis dollar is unlikely to sort of pan out. But even then, with this kind of a 3x kind of a move, this is not the best time to sort of chase gold. And which is why typically in a normal scenario, we suggest people to have 5 to 15% of their overall allocation towards gold. But now I would want to suggest that they should keep the allocation at the lower end of the range, which is as 5% rather than sort of 10 or 15 odd percent. Because it has already done so well, this is not the time to sort of turn very bullish on the gold. Structurally, yes, bullish bias is there, but given the sharp run up, I'll not be surprised if it does not do much for some period of time, and which is why that temptation to buy gold at elevated price, I think, should be done away with.
Absolutely. Sir, I think RBI also came up with some revision in the norms, particularly related to liquidity coverage ratio. How do we look at it?
So yes, Vishu. In fact, RBI has been sort of coming up with a lot of norms which are positive for banks. Now, LCR norms was another area where the banks have got a relaxation. I mean, to put it into simple English, banks accept various types of deposits. So you have, say, a saving bank account deposit, then you have wholesale deposits and other deposits. So, for example, saving bank account deposit is considered to be a stable deposit. So, if you are getting 100 rupees, what RBI was earlier saying that from 5% of that has to be put in GSEC, and that was supposed to be increased to 10 odd percent. Now that increase is going to be only to 7.5%. So you are giving a 2.5% kind of a relaxation there. Similarly, for wholesale deposit, they had to keep 100% as in GSEC. And now they have relaxed it by 60 odd percent. So this is definitely a big positive for the entire banking industry. What it does is that it releases nearly 2.7 or 3 lakh crore kind of a lendable resource, and which means that 1.5% kind of a overall incremental credit growth in the system. Mind you, we are looking at 12 to 13% kind of a credit growth next year. So obviously, this is definitely a positive. And within banks, I think it is definitely positive for companies or banks who have been sort of have a higher proportion of wholesale funding. So typically, Axis Bank and RBL Bank, I think, are better off. So overall sense is that the kind of measures RBI has been taking, I'm not surprised that the banks continue to sort of do well, and it is extremely important for us also because banks are typically drive 54% of your bank or Nifty earnings, and constitute nearly 34-35% in terms of weightage. So I think anything positive for bank is positive for markets and positive for Nifty.
Absolutely. Speaking of Axis Bank, I think it released its results as well this week. How did it perform, sir?
So, Vishu, slightly mixed kind of a number. So one, I think asset quality came out good, but I think the miss was largely the growth was quite lower than what the industry level growth. Now, advances growth was only 8 odd percent, whereas the industry level growth is somewhere about 11 and 12 odd percent. Sequentially, the growth has been better at about 3 odd percent. Retail again, growth has been 3 odd percent. So from that perspective, growth has been good. Growth has been relatively less than the industry. The term deposit growth has been better at about 14 odd percent. And what they've done better is that margins have seen an improvement on a quarter-on-quarter basis. So margins have improved by 4 odd bips. and fee income has been healthy. Asset quality has been quite decent at about 1.85%, and both the gross NPAs plus NPAs or net NPAs have declined. Now, the reason for liking Axis Bank is not because of the poor growth or any other factor. It is on a relative basis. If you sort of notice, a lot of competing banks, be it Kotak Bank or be it HDFC Bank, they have done well in terms of price performance. And Axis hasn't really done so well. So from that perspective, valuation wise, it becomes an attractive. And our sense is that with RBI taking measures for improving the overall credit growth scenario, Axis Bank is also likely to benefit. And whenever this growth improves for Axis Bank, then that is where it will do the catch up, and which is why we are bullish on Axis Bank despite a mixed set of numbers.
Absolutely. I think we also saw a number of IT companies releasing their results. How did we see that?
So IT companies, when you look at what they're clearly saying is that they're facing macro pressures, then there is a subdued discretionary spending, and we have seen results of HCL Tech, LTI Mindtree, Tech Mahindra, and then you have tier two names like say Mastech, Persistent, Emphasis. So all of them, largely the commentary has been on the similar lines. But there's some outliers. So outliers are that for example, Persistent, Emphasis, and LTI Mindtree. So they are saying that first half for them in terms of growth rate is expected to be good. So that is the outlier what we are seeing in tier two names. When you look at the current numbers, Tech Mahindra revenues declined 1.5% quarter on quarter. HCL Tech, LTI Mindtree again declined less than 1%. Most of them are quite optimistic in terms of maintaining their margins or improving their margins. So that is a good thing. And I think the best company what we have liked in terms of numbers is Persistent, because see, this is one company which has grown 19%, has given a revenue guidance of about $2 billion by FY27, which means that 19% kind of a growth rate. Compared to that, when you look at the tier one names, so there the growth rate is going to be 4 to 5 or odd percent. So clearly, it is beating them significantly in terms of growth. And I think even other tier two companies like say Emphasis is guiding for a strong growth, and even Mastech is also guiding for a strong growth. All I would want to highlight is that technology as a sector has taken the maximum amount of beating. And in case if there is some relaxation given to China, which is what Trump is hinting towards, and on top of it, if US is able to stave off recession or going to experience lesser recession, then IT could be one of the better sectors in the say next 1.5 years in terms of outperformance. One, because the sector has already corrected, and then overall, if the scenario does not turn out to be so bad, then it is one sector which can generate the maximum alpha. And which is why we've been suggesting in bits and pockets that for next 1 or 2 years, one can incrementally look at ETF or selective stocks, which we keep recommending on a regular basis.
Absolutely. We also saw some FMCGs companies coming with their results. We had Nestle, HUL, Tata Consumer. How did that go, sir?
So FMCG companies, the soft story sort of continues for them. So when you look at companies like say HUL and Nestle, the growth is quite tepid, about 2% kind of a volume growth. I think Tata Consumer that way is doing a lot better. Their overall revenue growth was 12 odd percent, and volume growth was around 6 odd percent. And most of the companies have witnessed margin pressure because you have raw material prices of tea, coffee, or palm oil, which has gone up, and that has impacted the margins. And overall sense is that some of these companies might get relief on the margin front. So, for example, TCPL or Tata Consumer is saying that the expectation is that the tea prices are going to sort of soften. So that will sort of help them maintain better margins, or will help them to sort of improve their margins going forward. However, HUL is clearly saying that they would want to let go some of the margins because, and they would get more aggressive on the volume growth. So this is a slightly shift in their strategy. What we have seen up till now, they have been looking to sort of protect their margins, but now they are looking to let go a bit of their margins in for overall growth. So from that perspective, again, no great exciting outlook. But if I have to call out a single name, then I think Tata Consumer clearly sort of stands out, because this company is saying that they are going to witness 6 to 8% kind of growth in core segments like, say, tea and salt business. And we all and some of the growth businesses like, say, Tata Sampann, ready to eat drink, Capital Foods. I think they are expecting about 30% kind of a growth rate, and this contributes nearly one fourth of their top line. So clearly, Tata Consumer is the top pick in the overall FMCG space, though I don't expect the FMCG as a segment to sort of do or outperform the market, given the rich valuations.
Right. So another result this week that was watched out for was ACC. How did that go?
So people compare numbers on a YY basis, but I think we need to sort of compare it some of the cost structures on a quarter-on-quarter basis. Now, volume-wise, we've seen this company doing very well. Healthy growth of about 14%. Quarter-on-quarter growth has also been about 11 odd percent. And so volumes have been a lot more better. Realizations are down 2.7%. But again, quarter on quarter, if you look at the realizations have actually improved by 2.7 odd percent. So overall, numbers have come out to be good. The EBITDA per ton quarter on quarter has improved by 52 odd percent to 673 odd. And this is led by lower cost. And I already spoke about better realization. And going forward, this company is going to do a capacity addition of about 4 million tons. In general, cement industry is expected to grow at 7 to 8 odd percent. Pricing is getting better. And see, for ACC specifically, the parent has been talking of an EBITDA per ton improvement of nearly 4 to 500 rupees per ton in the next 3 years, which augurs well for ACC and Ambuja. So currently ACC we are looking at. So ACC, which is why we have come up with a buy recommendation, and we feel that the entire cement as a pack is doing well. And I think then the Dalmia Bharat numbers were also pointing in a similar direction. So cement is well set to do well going forward.
Right. And before we leave, sir, could you also help us with some insights into insurance and AMCs? How are these sectors doing?
Oh, yes. So I think typically when you look at in the BFSI, my preference is again with banks. So banks are definitely the top of the league in terms of choice for allocation. And then you have multiple segments. You have insurance companies and you have AMCs. In the current scenario, the life insurance companies appear to be very attractive because they are available at the historically cheapest multiples. But I think you need to see a lot of, these companies need to be seen with a lot of external factors as well. So, for example, there is an implementation of surrender regulations. Then there is the new tax regime which has come in, where no deductions are allowed. And then there are multiple things which cap the valuation of listed insurance companies. And then there, on the positive side, there's an anticipation of reduction in GST rates. So all this is, again, when you look at this industry is expected to grow at 12 to 14 odd percent, and VNB margins are expected to be in narrow range. Now, from an investor perspective, like we have been sort of understanding, insurance is a bit complicated business for any normal person to sort of understand. I think it is the only analyst who can sort of understand this business well. For a lot of investors, a lot of variables are there, and which is why I think one should invest in models which are sort of easier to sort of understand. So that is where I think AMCs do a relatively better job. One, they are easier to track. It's an easier business and then favorable regulations as well, because there is the introduction of new asset class with a minimum ticket size of 10 lakh. You buy AMC, whether a large cap does well, mid cap does well, or small cap does well, I think the sector benefits. Then the penetration is definitely lower. So within the two, while bank is at the top on the league, I will any day prefer AMC because in AMC, typically revenue is about 40 to 50 bips of their entire AUM. The profit is about 22 or 25 to 35 bips of their entire AUM. So it's a very simple business model to sort of look at. And which is why the preference for AMCs is clearly there. At least I have a bias for that. While people can decide individually, but my sense is that AMCs are a better business to be into. It's easier to understand and easier to track.
Absolutely. Well, that was it for this week. Thank you so much for lending your insights, Pankaj sir, and thank you so much everyone for watching. If you have any questions, please do comment them down, and we'll try to get back to you. Thank you so much again.
Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.